Hi, good afternoon. Today, we are pleased to present the result of our investment portfolio project, which we have developed and analyzed over the course of several months. This presentation will walk you through the complete process we follow to construct, evaluate, and monitor our portfolio composed of 10 publicly traded companies across various sectors and geographies. We will begin by explaining the criteria and rationale behind our portfolio selection, highlighting the tools and insights that guided our decision making. From there, we will present a comprehensive fundamental analysis evaluating macroeconomics, indicators, geographical trends, sectoral dynamics, and the financial health of each company. This will be followed by a technical analysis where we will examine price behaviors, key sharp patterns, and momentum indicators. In addition, we have conducted SWOT analysis for each of the 10 companies, identifying their core strengths, internal weaknesses, and external opportunities, and key risks. Finally, we will showcase the performance of our portfolio, how this portfolio has behaved over the last 4 months, detailing how it reacted to major economic events, market fluctuation, and strategic adjustments. Let's talk about stock selection. To build our final investment portfolio, we use portfolio optimization techniques. We tested 4 methods: maximum Sharpe index, maximum return, minimum standard deviation, and maximum Sharpe ratio. After doing this, we focused on the companies that appear in multiple optimizations, so which ones were more constant and reliable. For example, KGAI appeared the most often. Then we built a new portfolio with 13 of these repeated companies and apply new constraints. For example, no company could exceed 10%, and they also had to have at least 10%. After solving within these limits, we saw which companies held weight and which were discarded. So for the final adjustment, we, for example, remove 2 companies because of qualitative reasons. Basically, they didn't align with our strategy. Both Sharpe ratio and Sharpe index gave the same results. So this way, we validated our final 10 company portfolio. But to prevent overconcentration, we added new limits: a minimum of 2% and a maximum of 25% concentration per company. This was our final output. We chose the 10 companies like BG Wholesales Club, Finvolution Group, Boston Scientific Corp, Huron Consulting Group, Epsilon Energy, Colibri Global Energy, Zijin Group, Liquidity Services, Orla Mining, and Star Group. And these were the weights that we allowed to each one of them. BSX had a 21.8%. ORN had a 15.2%. LQDT had a 5.4%. PJ had a 25%, being the biggest percentage in our portfolio. Orla had a 4.5%. SDU had a 5.8%. EPSN had an 8.4%. KGAI had a 2.2%. And FIMP had a 9.3%. These were the respective wages for each one of them, which allow us to have and enhance our diversification and the concentrations based on the restrictions we introduced. Our fundamental analysis gave us key insights into where the global economy is heading, how geopolitical tensions are shaping investment risks, and which sectors align best with our portfolio strategy. This analysis helped us ensure that the stocks we selected weren't just statistically optimal, but also fundamentally sound. In this fundamental analysis, we included three basic and the most important analysis. We include a macroeconomic analysis, a geopolitical analysis, and a sector overview. But let's talk a little bit about key events that happened in each of these overviews. First, the return to U.S. tariff. In early 2025, President Trump reintroduced aggressive tariff on imports from China, Canada, and Mexico, sparking a new phase of trade tensions. This caused higher import prices, which led to rising inflations. Now they are at 3.9%, slowed GDP growth down to 1.6%, and increased volatility across the consumer, discretionary, and industrial sectors. Then we have China's economic rebound in Q1 of 2025. This in the geopolitical sector mean that China beat expectations with 5.4 GDP growth in Q1, driven by manufacturers and high-tech exports. The bolstered confidence in China's companies like the Jinfeng Group and the FinEvolution both in our portfolio. However, rising geopolitical tensions in the South Sea China added some risks to this otherwise strong recovery. Lastly, we have in the sector part, we have that energy sector volatility due to global supply tensions. Ongoing logistical disruptions in the Red Sea combined with the new US geopolitical strategies have caused instability in global energy supply chains. This has led to price volatility affecting companies like Colibri and Epsilon Energy, which have strong returns but are exposed to commodity price risk.
Moving on with the technical analysis, we used the trend indicators, volatility indicators, and the momentum indicators. For the trend indicators, we used the simple and exponential moving averages, the Ichimoku clouds, and the parabolic SAR. For the volatility indicators, we used the Bollinger Bands, the Donchian channels, and the average to range. And the momentum indicators, we used the relative strength index, the stochastic RSI oscillator, and the momentum. So here we have the advanced charts of all 10 companies. At the top, we have the companies that had better returns, and at the bottom, we have the companies that a little bit of a bad returns. So we can see that most of the companies, with the exception of Boston Scientific, Colibri Global, and Liquidity Services, had green Ichimoku clouds. We can also see that the companies at the top have a high momentum and are mostly overbought, and the companies at the bottom have medium to low momentum and they are mostly oversold. We can also see that for the parabolic SAR, the companies at the top had a lot of reversal points, but mostly the purple dots were below the price candles, while the companies at the bottom had not that much reversal points, but mostly the purple dots were above the price candles. And we can also see that actually for the companies at the top, they had high volatility, while the companies at the bottom had low to medium volatility. So that is something to consider. And we can also see that for the companies at the bottom that I just said that didn't have a good performance for the stock, we can see right here that most of the companies actually are showing a bullish performance, low volatility, and medium to high momentum recently. So they are showing growth potential in the future. So for the initial investment, we invested $100,000 that are composed of US, China, and Canadian stocks distributed in several sectors. And for the period studied, that is March 20th to May 23rd, we had a overall return of minus 0.99%, which is also a loss of $988.01. And as I said before, we have 5 companies that had positive returns, and there are 5 companies that had negative returns. So for the positive performing stocks, we have Orla Mining, which had a 14.03% return. We have BJ's Wholesale Club, which had 3.28% for returns, and Boston Scientific that had 2.58% positive returns. But for companies that didn't perform that well, we have Liquidity Services that had minus 20.91% of the returns. We also have Emulsion Group that had minus 9.41%, and we have Colibri Global Energy, which had minus 12% of returns. And obviously the negative returns are overriding the positive returns, which also contributed to the losses that we registered in the portfolio. We can also see that there were 2 key performance events. The worst daily return, which is right here on April 8th, following Trump's announcement of the tariffs, which triggered a broad market sell-off and uncertainty. We had a negative return of minus 7.06%. And there is the best daily return on May 6th, which also coincided with a strong recovery momentum, especially from international and energy stocks. And we have a positive return of 2.19%. After 39 trades, the investment weights changed a little bit, which we can see right here. Companies like JFIN, which had 12.6% as an investment weight, had now 2.3%. And for the company that performed the worst, which is LQDT, that had a percentage of around 3%, now has less than 1%.
After we know all this information about our portfolio, it is important to know or to make the SWOT analysis of it, just to confirm that it is the best option to invest, because we have a lot of advantages and positive things to say about our portfolio. It's for that we are going to begin with the strengths of our portfolio. That in the first step we have diversification by sector, because our portfolio includes the exposure to various sectors that includes energy, healthcare, financial technology, consumer, mining, and more, that it's reduce our risk in only one sector. Then we have companies with good financial results. For example, BJ shows a sustainable growth in sales and cash flow. Also, we have Boston Scientific that had solid margins and leadership in medical devices. And Orla Mining operates without debt, which is very good, and talks very nice about our portfolio. In energy, also we have a Colibri and a Pilsen that had increased these revenues thanks to the higher oil and gas prices, which strengthens to the portfolio profitability. And there is also a potential in fintech, such as FinB and JFine, and which operates in emerging markets with high digital growth. Then we have some weaknesses that is not our main focus, but it is something really important to say, that many of our companies, such as Liquid Debt, Colibri, FinB, and JFine, are small and mid-cap companies that can lead to more volatility and lower liquidity in the market. And in addition, the portfolio doesn't include classic defensive sectors such as telecommunications or regulated utilities. In this SWOT analysis, also we have some opportunities to our portfolio. Several companies are positioned in sectors with positive trends. For example, FinB and JFine can benefit from the growth of digital credit in Asia. Boston Scientific is innovating in the cardiovascular area with a strong R&D investment. Also, we have Colibri and Pilsen can continue to take advantage of high gas and oil prices and new exploration opportunities. BJ is gaining market share with its membership model, and we can also, going forward, better balance to the portfolio by incorporating more stable or dividend yielding stocks. And finally, we have the threats that there are significant regulatory risks. For example, JFine operates in China, where fintech face an increasingly stronger control. Colibri and Pilsen are exposed to changes in environmental policies and energy transitions, which could affect their operation in the future. In conclusion, after this analysis of the selected 10 companies portfolio, we firmly recommend that buying this portfolio as a strategic and forward-looking investment. This recommendation is grounded in both fundamental and technical analysis, and also in our SWOT analysis. We conduct, which highlighted a solid balance of strengths and future potential across various industries, as we mentioned. Our portfolio also offers a broad sector diversification, including fintech, healthcare, energy, consulting, mining, retail, and consumer goods, that it is represent an advantage in the market. Financially, many of these companies shows a strong cash positions, growing revenues, and compelling valuations metrics. Also, this portfolio is not only financially sound, but it is also aligned with the current trends that the market has. And for all these reasons, we confidently stand by our recommendation: buy and hold this portfolio for sustainable long-term return.